Will the deaf bull start listening soon? Last week I showed you a photo of a blind bull, and today here's an AI generated image of a deaf bull with huge earplugs. And is another great analogy for what we've been seeing all year as the bull market continues to ignore the beating drums of recession. But how much longer can this continue for? And that's what we're going to talk about in today's video. Welcome back everybody. My name's Jared and I'm from Click Capital, and I'm going to run through all the latest market data analysis and charts for you today. And if this is your first time here, stick with me through to the end, and I promise after watching you will have a great understanding of what's going on in the markets, especially with price action, as I go through the same process every day. And if you watch every day, you will start to get a feel with what's going on in the markets. So be sure to hit that subscribe button with notifications, and I make these videos for you guys every day so you can stay updated with the markets and price action. Okay, let's get into it. So today was a pretty quiet day on Wall Street. Mostly green out there. You can see tech came off, especially mega cap tech. The market's pricing in a greater chance of a Fed hike in the next meeting in May. And we had a really narrow range, low volume day today as we've got inflation data, CPI, coming out tomorrow, and I think that's going to sway the market in a big way. So we'll be watching this inflation rate year over year one here with consensus at 5.2%. Previous reading came in at 6%. And if inflation were to come in above 5.2, I can imagine the market might sell off as it prices in a greater chance of the Fed hiking. And later this week we've got PPI and retail sales to give us more of a read on the health of the consumer. And here's a 3-year chart of that inflation data that we've got coming out tomorrow. So the Fed's target is to keep this number at 2%, and you can see we went above that in April 21, got up to 9.1 in July last year, and have been trending down. So if we were to get consensus reading tomorrow, that would take us down to 5.2, which is about here, which would be a bit of a significant drop and could add weight to the theory that the Fed hikes are getting on top of inflation. However, if we were to come in above that, then it may prove that the Fed has more work to do. So we'll be watching this one tomorrow, as it's kind of the last big read the Fed is going to get before their Fed meeting in 3 weeks. And this could have a big impact on the stock market tomorrow. Fear and greed index is still a little elevated up here at 60, and it's around the levels where we see short-term market tops. So in my opinion, if we haven't already put in a short-term top, we are getting close to it. And another index I'm going to start tracking for you guys is the NASDAQ exposure index. So this kind of just shows the mood of active managers and how bullish they are on the market, and you can kind of look at it like the fear and greed index as well as a contrarian indicator. So that's a little elevated as well up here at 72.8. So again, another indication that we may be nearing a short-term top. And this chart here shows the spread between the SP500 earnings yield minus the 2-year bond yield. And you can see that's as low as it's been in the last 10 years. So stocks are just offering very little premium over 2-year bonds. And even worse when we look at the dividend yield minus the 2-year bond yield. That's actually negative. And this is what I've been talking about by the valuation difference between stocks and bonds is as worst as it's been in the last 10 years. So even though the stock market has come off from its peak around 4,800 on the S&P 500, the increase in bonds has decreased the yield on what you can make in stocks versus bonds. And that typically acts as a strong weight on stock prices. Dark pool index, which measures the level of buying activity in dark pools, which is typically done by large, sophisticated institutional traders, has just gone slightly into bearish territory under 45%. And we can see as the S&P 500 has been rising this past couple of weeks, that has been decreasing. So dark pool buyers have been pulling back on their purchases. Company insiders as well, which have to report their purchases and sales, are really low here. They haven't been buying much of their own stock of late either. Quiet day in the options market, only 29 million contracts traded against an average daily of 40.5, and 57% of them were calls. So a continuing trend we've been seeing lately with not much fear out there, not many people buying puts. And we can see that between small traders and retail, it makes up almost half of all options being traded. And 64% of all options are less than 10 days to expiry. Fed fund futures increased their probability today to almost 73% chance that we get a hike at the next Fed meeting in May. And that's what's helped tech stocks pull back a bit here today, as tech stocks don't like higher rates. And another interesting statistic for you here today is that if October last year was the low on S&P 500, as many people are claiming, then it is the second slowest recovery to 20% in history. So typically after we put in a bear market low, it will take on average 68 days before the S&P 500 bounces 20%. And we're currently at 122 days and counting, as that hasn't been made yet. The S&P 500 would have to reach 4293 for it to be up 20% from October. And that 4200 is a big level we're looking for resistance. And this year has not been a broad-based rally. In fact, the S&P 500 has added almost $2 trillion in market cap just from the top 20 largest stocks. The bottom 480 stocks have only added $0.17 trillion. So that narrow leadership is not something you see in a bull market. Typically in a bull market, you see a lot of breadth, a lot of participation across the board. And an important development for the US consumer is the credit card interest rate is at multi-decade highs, now above 20% interest being paid on credit cards. And on top of that, total credit card debt is now almost $1 trillion. So we've got record credit card debt with record credit card interest rates. It's not a good combination for the consumer. Okay, that's a look at some data today. Let's head on over to the charts. So a very quiet, narrow range today in the S&P 500. We closed just above 4,100, but we'll come back to this at the end of this video like we always do. We'll just have a look at all the other major market categories. So overall, international indices, TSX Canada, still overall bullish out there. FTSE as well, above the 50-bar average. Same with DAX, the Nikkei. Australia had a good day yesterday with commodities, and China just kind of consolidating there. Implied volatility still really low in the market. We've got the VIX at a 19, just above this big support level, around 17.5. However, the volatility risk premium over realized volatility has been creeping up this last week, indicating the market may be starting to price in a bit of upcoming volatility. And we got bond market volatility still elevated at 139 on the MOVE index, with the premium of bond market volatility over stock volatility still really elevated up there. Put call ratio at 0.84 indicates not many people buying puts. There's not much fear out there in the market. And breadth popped up today with 83% of their stocks above the 20-day average, 50% above the 50, and 58% above the 200-day average. So a little bit of breadth coming in the market there, but not many stocks making new highs. That hasn't broken out yet. Only 36 on the NYSE and 44 on the NASDAQ. We zoom out to a 2-week chart. You really need to see that get consistently above 100 before we can say we're in some sort of new bull market. Over to the spreads, and growth cyclical sectors versus defensive has come off and a bit weak here under the 50 average. Same with high beta versus low volatility stocks, and growth versus value stocks have pulling back but still on an uptrend above their 50. Small cap stocks as measured by the Russell versus the SPY had a bit of a bounce here today after having one of their worst months relative to the SPY last month. So still very oversold down here. And international stocks still holding above their 50 versus the SPY. High yield versus treasury still under the 50, and the 2-year today at 4.03, 10-year at 3.43, holding this big support zone we've been watching. And June Fed fund futures are implying a Fed fund rate of 5%. So the market's basically saying we're going to get a hike in May, then they're going to pause, and then come September they will be cutting down to 4.83. And in December we'll be at 4.45. So basically the big change came after the closure of Silicon Valley Bank on the 10th of March here. Basically, the market was saying we weren't going to get cuts until next year. But after the banking crisis, the market kind of pulled that all forward by about 6 months and is saying in the second half of this year, the Fed is going to have to start cutting because we'll be going into a recession. And this is very different to what the Fed has been saying. They're not saying this. They're saying they're going to have to keep raising and getting on top of inflation. So there's a big divergence between the rates market and what the Fed is saying. Treasuries were flat today. High yield just came up a little bit. Dollars holding firm here at this big support level around 101.50. And Bitcoin, you heard me talking about this yesterday, is coming up to this big resistance zone here. Actually got above 30,000 today. And if we just go out to a weekly chart, We can see this is a big level. After forming this bull flag, this could still have some further legs to it and go for a bit of a run here. And even though we saw Bitcoin break out to new year-to-date highs, we didn't see the same in Ethereum today. That couldn't quite break out last week's high. Commodities still looking good here, holding strong on this gap up. Looks just like crude here. It's defending this gap up. Gold as well, holding above $2,000 an ounce. And natty gas looks like it's still continuing to try and find a bottom on this big volume down here, which has pretty much been the case almost all year. And over to stock sectors, mostly green out there, except for tech that came off today. And semis came off a bit. Communications, we saw retail hold up 1.6%. Oil and gas had a good day here, well above its 50. Gold miners actually broke out to a new high and in a strong uptrend. And surprisingly, home builders as well, back above its 50 and really holding on there, even in the face of record low new mortgage applications. And the financial sector, looking like it might have put in a bottom here, starting to flirt with its 50 bar. So if we get above that 50, that's more likely to have made that a low on the 24th of March. However, the financial fund is made up more of the big banks. The smaller one, regional, still trading really heavy and weak down there, still trying to find a bottom. And defensive sectors were pretty flat today after we've had a really good run this last week or two. There's staples and utilities. Looks to be still trading strong and holding up there. Got some big bank earnings coming out later this week. BlackRock had a good day today, back above its 50. And I follow this one every day and call it the BlackRock barometer because it often correlates really well with the stock market and can kind of be a bit of a leading indicator since most of their business is based on how many funds they have under management. So it's a good way to gauge the health of the stock market. So we'll be looking to see what they say later this week on their earnings and what they are seeing out there in the market. Same with JP Morgan. We got their earnings coming out later this week, and we'll be looking to see what they say about all this banking crisis and how they're seeing deposits and lending and of course their forward guidance. So in addition to inflation data tomorrow, the bank earnings later this week could have a big impact on the stock market as well. ExxonMobil still trading really strong with oil. Tesla had a little bump today but still under its 50 bar. Apple's pulled back into its big resistance zone. Same with Microsoft, and Amazon had that pullback as well, along with Google and Nvidia. Looking for this to have maybe made a topping formation. We may have already seen that top there at 280, or we could still see 290 towards 300. So this has been on a tear all year, up 90% and super overvalued. And I'm looking to get short this, possibly above 280 towards 290. Coinbase had a good move today, gapped up and held above its 50 with the price of Bitcoin rallying. And overall, the meme stocks had a pretty positive day as well. Did have earnings come out from CarMax today. They beat significantly and the stock market loved it, marking it up almost 10%. The other banks kind of just hanging in there. Bank of America had a nice move up today. Got Citi earnings later this week, as well as Wells and Charles Schwab as well on Monday, which will be a big one because there's been a lot of controversy lately in this stock, and so it will be really interesting to see what they come out and say, because if this thing continues sliding, I think that could really rattle the stock market. Otherwise, if we get the all clear from them, there's no reason why we can't have a big pop in the stock price. Okay, so that's a look at all the major market categories. Let's go back to the main indices. So this is the SPY sitting at this big resistance zone, which is around 4100, 4150 on the SPX. And you can see today we had a super narrow range and low volume, which we've been seeing over the last week. So volume and volatility is really coiling here, and volatility is really cyclical. It coils, then uncoils. So I'd imagine tomorrow with this inflation data, the market could be coiling up into that. It could uncoil yesterday in either direction. Year-over-year consensus at 5.2%. If we were to come in above that and much above that, we could see the market sell off quite hard as it prices in higher rates from the Fed. Otherwise, if it were to surprise on the downside, we could see the market hold and even rally somewhat as it prices in a more dovish Fed. However, looking at the NASDAQ today, it seems to be saying that we're going to have inflation hold, or if not come in higher, as the market was pretty green across the board except for tech stocks. The Dow managed to break out with higher highs and higher lows there today, and we've got mids just above their 50 now, but Russell came up and tagged its 50 and bounced off. So still really weak in small caps. And so it's still a big divergence between small and mega cap stocks. So it's really been mega cap stocks, as we can see in the NASDAQ, that's been holding up the market pretty much all year. So tomorrow should be interesting, and more as we get into the week as well, with PPI and retail sales and bank earnings. So if inflation would have come in hotter than expected, retail sales would have come in weaker, and the banks reported weak numbers and weaker guidance, then we could really see the market come off hard going into the weekend. But until then, I'm remaining market neutral, equal amount of longs and shorts. And that sums it up for today. Thanks very much for watching. And if this is your first time, hit that subscribe and notifications button. I do these market reviews every day after close to keep you up to date on what's happening with the markets. So come back tomorrow. It should be a really interesting one. See you then, guys.